Sure. Your money deserves better decision. How? Rahul and his wife had 25 lakhs got from property sold. Now this story begins. So now no idea where it should go. Either it should go for FD or gold or insurance or mutual funds. So now this session exists to answer that question simply. So before that story begins, let us see what are mutual funds. Mutual fund pools money from many investors and invest into stocks, bonds, or other securities, which was managed by professional fund managers at AMCs. What is NAV? Net asset value is the price of one unit of mutual fund calculated and published at the end of every trading day. When you invest, you do not buy shares of the fund. You get units equal to your investment amount divided by that day's NAV. Okay. As the fund's underlying investments grow in value, the NAV rises, and so does the value of the units you already hold. Now, generally, mutual funds in India are regulated by SEBI and distributed through AMFI registered advisors like KG Finvest, ARN number 301473. For transparency and investor protection. I'll give you one example. NAV is 50 rupees per unit. You invest 5,000 rupees, you get 100 units. If the NAV later grows to 65, your 100 units are now worth of what? You purchased at 5,000. Now it's worth of 6,500. The gain of 1,500 rupees without you doing anything after initial investment. Now let us see one more example. Ram and Sham same as 10 lakhs with two different ways of investment. Ram put investment of 10 lakhs into fixed deposit at 7% per annum. Sham put the same amount in equity mutual fund, assumed at 12% per annum, and stayed invested for 10 years, both of them. Now let us see a 10-year money story. Ram deposited 10 lakhs at the rate of 7% for 10 years. Sham also invested into equity mutual fund, which returned 12% per annum, invested 10 lakhs for 10 years. After 10 years, Ram grew his money of 10 lakhs to 19 lakhs, 0.7. Now, same with Sham, after 10 years, it grew to 31.1 lakh. Now, FD provided safety and stable, lower long-term growth. Now here, market up and down, stronger, longer term potential. Sham ends up 11.4 lakhs ahead of Ram. In this illustration, by staying invested for long term. This is an illustrative example. FD per annum 7% and equity mutual fund 12% per annum assumed. Mutual fund returns are market linked and not guaranteed. Past performance does not indicate future results also. So in this lesson, in this moral, in this story, the moral is Ram choose certainty, Sham choose long-term growth. The right choice depends on your financial goals, time horizon, and comfort with investment risk. Not everyone should choose the same option. Compare your own numbers. So you can compare here how you want to go. Now Sensex has had crashed. It has long history, Sensex, which has seen crashes, scams, wars, and pandemics like Corona. Along the way, 2008 to recession and 2020 Corona. More than one. This time it's different. None of them shown up as anything more than a dip of 46-year chart. Now let us see the chart. Sensex started at 1979 with 100 points. In 2000, it was somewhere around 4,000 points. Again, in 2010, it was 20,000. Again, in 2020, it was 47,000. When it was 2025, it was 85,000. So, if anybody or grandfathers or maybe fathers have invested 100 rupees in the year 1979 in the index 1979 tracked to rupees 852 by 2025. So that value would have been today 852 rupees in 2025. So now you can also try mutual fund basics, SIP calculators, and ELSS live calculators, then portfolio diversification, then goal planning, insurance, loan advisory, and retirement planning, child education, house purchase goal, emergency fund. So these are the things you can also try. It's online and it's free. Now let us look in a short type of mutual funds. Equity invest mainly in company shares for longer term wealth creation. Debt fund invests in bonds, fixed income securities with relatively low risk. Hybrid fund mixes with equity and debt. Index passively tracks a market index with like Nifty 50 or Sensex. Large cap fund invests in India's largest and well established companies. So mid cap invest in medium sized companies, small cap invest in smaller companies with high risk and high return potential. So flexi cap freely invest across large, mid, small cap companies. Multi-cap fund mandatorily invest across large, mid, and small caps. So the basic difference, Flexi has liberty and multi-cap has to be capped at certain percent, 35, 35, 30. Multi-asset fund invest in three or more asset classes such as equity, debt, and gold. Better diversification. ELSS equity fund offering tax benefits under Section 80C with three-year lock-in. Sectorial or thematic fund focuses on specific sector or investment theme. International fund invest in companies outside India for global diversification. Focused fund hold holds a concentrated portfolio of up to 30 stocks. Arbitrage fund earns from price differences between cash and future markets. Liquid fund invest in very short-term money market instruments. Overnight fund invest in one-day maturity securities with minimum interest rate risk. Corporate bond fund invest primarily in high-rated corporate bonds. Gilt funds invest only in government securities. Children's fund designed to build wealth for child's future goal. A retirement fund helps accumulate a retirement corpus with long-term focus. Growth, if you want growth, choose equity funds, safety, debt funds, balance, hybrid funds, low cost index funds, and diversification, you can select multi-asset funds. Tax saving ELSS. So one more time, we would like to disclaim mutual fund investments are subject to market risks. Read all scheme related documents carefully before investing. Thank you. One more thing. Large cap versus mid cap versus small cap. There is a fixed rupee size per mid cap or small cap. SEBI's classification is based on market cap rank, not rupee value, and the rupee figures people quote go stale fast as market grows. Good to know the approximate rupee ranges below illustrative only. As of AMPI's own published classification list, the actual large cap cutoff already run well past 80,000 crores, far above 50,000 crore plus. Shorthand often quoted always AMPI's latest list. So large cap top 100 companies by market cap, often 50,000 crore plus. Currently higher. Mid cap rank 101 to 250 range. Roughly 15,000 to 50,000, currently higher. Small cap rank around 250 onwards, generally below 15,000 crores. Large cap, big established companies, mid cap, growing companies with real expansion potential. Small cap, smaller merging companies. So let us take one more example. Priya never felt like she was investing anything. She just skipped one coffee a day, about rupees 100. She redirected into a SIP that roughly 3,000 rupees a month. Over 10 years at assume 12% per annum, that grows to 6.97 lakhs against 3.6 lakh actually invested. This is only illustrative example, assumed 12% per annum return. So now similar to engineering, MBA, foreign education, 8,000 rupees has been invested for 12 years at the rate 12%, which has got 25.8 lakh. So you can plan your child's education, and retirement planning is very, very important because people think by 60 everything has been over, but I feel from 60 another 25 years has to be lived. So if you're not planning retirement, so then it's a very huge mistake. The difference between these two leaves, let us see, 50 lakh built from 12 lakh invested. So now person A on the left side has no planning, he got financial stress. The person at the right side, SIP started 20 years ago, financial freedom, 5,000 rupees a month into 20 years, that is at the rate 12% per annum, equal to 50 lakhs corpus. So always before plan. Now even ELSS, people are more worried about taxation. ELSS funds under Section 80C do double duty, deduction on the way in equity growth potential while it's invested. And one of the shortest lock-ins is 3 years among 80C options. Investing the full 1.5 lakh per year, 12,500 per month, limit for 15 years at an assumed 12% per annum could grow to 63 lakhs against what you invested, 25.5 lakh. So wealth grows slowly, then suddenly. You plant the seed, roots take the hold, return starts compounding at 5 years. Growth accelerates at 15 years. Then the money tree compounding does the heavy lifting. See your own compounding calculator. Every investor starts somewhere, from never invested to building wealth. The path is shorter than it looks. Never invested, attends session, starts SIP, review yearly, builds wealth. So you do not be investing alone. SIP Nation, the scale of discipline investing in India. 31,000 crore invested every month through SIPs across India. 9.64 crore SIP accounts actively contribute every month. Now, around 17.12 lakh crores total SIP assets under management. Wow, that's very great figure. Every month, Indian investors invest nearly 31,000 crore through SIPs. into mutual funds. That's over 1,000 crore being invested every single day by people building wealthy wealth systematically. SIP journey of 2,000 rupees. For 5 years, you invested 1.2 lakhs. It grows to 1.65 lakhs. So for 10 years, it is 4.65, and it is for 20 years, 19.98 lakhs, and 30 years, it is 70 lakhs. Even 2,000 rupees makes much difference. This is an illustrative example, not guaranteed. Mutual fund investments are subject to market risk. Read all scheme related documents carefully before investing. Run your own numbers. So market down 8% and first instinct was to stop the SIP. No. So his advisor said one thing, continue market that falls also recover, and paused SIPs misses recovery. It was built to capture the investors who stayed invested were ones who came out ahead. Let us see. So we will cover in next session inflation erodes value, rupee cost averaging, and with some more examples. So thank you guys for attending this session. We'll also cover in next session taxation part. Thank you.